Welcome to The Explainer. We're talking today about what feels like a perfect storm brewing for the U.S. economy. As the first quarter of 2026 wrapped up, we saw this potent mix of really nervous consumers, a big global oil shock, and a Federal Reserve that seems kind of trapped. All of this is pushing recession fears right to the boiling point. So let's break down exactly what the data is telling us.
So, the big question is the economy really hitting the brakes? Well, right at the end of March 2026, two key pieces of data basically flashed red, and that signaled a pretty meaningful shift in where the country's economy might be headed. Let's get into what they are.
Okay, let's dive into this. On one side, you've got the American consumer, who's suddenly feeling a whole lot less confident about things. And on the other, you've got one of the world's biggest investment banks officially raising the odds of a recession. We're going to start with how everyday people are feeling. First up, consumer sentiment. Now, this isn't just some vague feeling, it's a really critical economic indicator. And in March, it took a sharp, really unexpected turn for the worse.
So the final number from this really closely watched University of Michigan survey, it came in at just 53.3. Now, that not only missed what all the forecasters were expecting, but it also marked the lowest level of confidence we'd seen in 3 months. Ouch.
What's really interesting here is the context. See, this drop wasn't just some small dip. It completely snapped a 4-month winning streak. Confidence had been steadily climbing back up, and then, boom, it just fell off a cliff in March.
So when you dig into who is losing confidence, it gets even more telling. The short-term outlook just plummeted, and people started worrying more about inflation again. But here's the real kicker. The biggest drops in confidence came from middle and higher income households. That's a huge red flag, because these are the folks that drive so much of our discretionary spending, on things like travel, cars, and dining out. When they pull back, the whole economy feels it.
All right, let's switch gears to our second data point, which actually came out just 2 days before that sentiment report. Wall Street giant Goldman Sachs raised its official probability of a U.S. recession to 30%. And this was the second time they'd done that in less than a month.
So why the sudden pessimism? Well, Goldman pointed to a few key pressures. The boost we got from past government stimulus, that's wearing off. The job market is showing signs of weakness. And then there's the big one, a massive global oil shock.
And that right there brings us to the culprit connecting all of these dots. Seriously, the common thread running through the weak consumer sentiment, Wall Street's worries, and those inflation fears is a major disruption in the energy markets.
Okay, so escalating conflict in the Middle East choked off supply through the Persian Gulf, and that triggered one of the most significant energy disruptions we've seen in recent history. As you can see, Brent crude oil just shot up from around $70 a barrel to a peak near $119 before it settled back down a bit. This global event had a very real, very direct impact right here at home for all of us. It's what pushed average gas prices across the country toward that painful $4 a gallon mark, hitting consumers directly in their wallets and, shaking their confidence.
Now, this combination of rising prices from the oil shock and a potentially slowing economy, well, it puts the U.S. Federal Reserve in an incredibly difficult position. They're basically walking a tightrope with no safety net.
And this really lays out their dilemma perfectly, doesn't it? If they cut interest rates to try and help the slowing economy, they risk making inflation even worse. But if they raise rates to fight inflation, they risk pushing the economy into a full-blown recession. It's a classic catch-22. So the key takeaway here is that this is what economists call a stagflationary dynamic. You've got stagnant growth plus high inflation. It's pretty much a policymaker's nightmare. And it's precisely why the Fed chose to do nothing in its last meeting. It held rates steady, completely caught between a rock and a hard place.
So, with all these warning signs flashing, is a recession just a done deal? Well, not so fast. There's actually a pretty lively debate happening on Wall Street about what happens next.
So while Goldman Sachs has set their odds at 30%, they're definitely not the only voice out there. Prediction markets, which a lot of people see as a good gauge of collective wisdom, have the odds even higher, at nearly 40%. And Moody's forecasting model, it pegs it at almost a 50-50 chance. But there is a strong counter-argument. Some firms, like BNP Paribas, are arguing that this isn't like the oil shocks of the 1970s. The big difference now is that the U.S. is the world's largest crude oil producer, which gives the economy a kind of structural advantage and a cushion it never had before. So here's the crucial point.
The U.S. economy is rolling into the second quarter of 2026 in a pretty fragile state. The next few months are going to be a major test of its resilience.
Think about it. It's heading into this period carrying the weight of the ongoing energy shock, a job market that just lost 92,000 jobs, nervous financial markets, and a very significant diplomatic deadline with Iran on April 6th that could either calm things down or, heat them right back up.
And all of that leaves us with a big question. Will geopolitical de-escalation ease the pressure and let the economy stabilize? Or will further disruption from this perfect storm of wary consumers and high energy prices just cement these stagflationary fears and stall growth? The data we see over the next few weeks is going to be absolutely critical in telling us which path we're on.